Okay, in this tutorial, I'll be going through with you a stock which is VIA. I'll just copy this and I'll paste it in Google and write stock besides it, and I can see the name Viacom and its information. This information is from Wikipedia on the right, and on the left it's from Google. And if I want to know that what does the stock cost right now, if I buy it, it's 35.59 US dollars. That's the currency. And when was it founded? I can just see on the right hand side, I can click Wikipedia, and then there's a box inside, and it says founded, and it says 2005. It's 13 years ago. And then if I want to know that the sector, I'll explain you later in the video. Right now I want to concentrate on the four ratios that are very important when you are analyzing the stock. I have left in the link in the description, and it's for the website called Macro Trends. And you can just click that, and this thing will appear. And price ratios, click price ratios, and then price book ratio, and paste the um, paste the symbol of the firm, and click on the name, and just to make sure that the name matches the one in the Google Viacom. Yes, it does, and that's Viacom, because sometimes it's the same symbol for many firms, so you need to be careful. I'll explain you briefly what price book ratio is. Book value is the real value of the stock, and stock price is the market value. For example, if the book value is $1, which is the real worth of the stock of the share, if it's $1 and the market price is $2, so it means that you're buying something that is only $1 worth with $2. So you're paying $2 for something that is only $1 worth. So it means that you're buying an expensive stock. When looking at price to book ratio, um, you just need to be careful that if the ratio is less than 1, that means the stock is very at bargain and it's undervalued, and it's the ideal time to buy. If it's 1, that means that the real worth of the stock is same as the market price. So it's not expensive, but it's not a discount at the same time. So it's equal to what it should be. But if it's more than 1, if the ratio is more than 1, it means it's an expensive stock. And the higher the number goes, the more expensive it gets. Right now, it is 1.78, which means that you will be, if somebody buys the stock right now, they will be paying 1.78 times more price for that stock. So it's expensive than its real worth, but it's 1.78 times expensive. But it got the most expensive it went um, in 2015, when it was 10 times 68 10 times, nearly 10 times more expensive in 2015. So now it's cheaper, it's a lot cheaper than in 2015, but still it's a bit expensive, so you need to be careful about that. Then if I just go to other ratios, I can see the current ratio. Current ratio tells me that the assets are, if the assets are more than liabilities, it acts as like we're looking for margin of safety. So we're looking that stock is not risky. So the current ratio, if current ratio is 1.5 or more than that, then the stock is not risky. If it's 1.5, if it is less than 1.5, then the stock is risky to invest in. So right now it's 1.29. So it means that even though the assets are more than liabilities, you can see vertically up, liabilities are 3.87, assets are 5. So even though assets are more than liabilities, but there's less margin of safety, there's still a risk investing. If I go back, it's 1.5, then 1.69. So it's up and down. And even like in 2016, June, it's 0.99, which means that liabilities are more than assets, which is very risky. You can always see the thing vertically up and compare the liabilities with asset. If you just go back, it's up and down, and it's just fluctuating, so it's not very reliable right now, maybe. uh, you know so you need to be careful about that, and also check the previous trend as well, because it could be that right now it's 1.5 or more than that, but just like few months back it's not like that. So it's just fluctuating for this stock. If I go to debt equity ratio, this ratio tells me that if the company is mainly operating on long-term debt or on long-term equity, on equity, sorry. If the ratio is zero point 0.5 or less than that, it's safe to invest in. It's not a risky stock. Right now it's 1.08. It means that it is operating more on long-term debt than on equity, because it's like more than one. So it's 1.08. If you just see vertically up, it's 8.03 is equity and 8.64 is debt. So debt is more than equity. So this is very risky because there's no margin of safety, because it's operating more on long-term debt, which is not very good for the firm. If I go back, still long-term debt is more. And if I just see the trend, um, you know, there okay, so after 2012 March, since like now 6 years, there has been more debt than equity, shareholders equity. And there has been no time when the debt was less than equity. Debt has always been more than equity since 2012. So it's been like now nearly like 7 years now. Constantly the debt has been more than equity. So this is very risky to invest in because there's more debt. It's operating mainly on long-term debt. So, it's very risky to invest in. Let's see, return on equity. Return on equity should be 8% or more than that for it to have, give a good return. Let's see. It's 21%, which is more than 8%. Let's see the previous ones. Um, So that's really good. So return on equity has been always been above 8%, which is very very good. It means there's a margin of safety. So the return has been very good thoroughly. So since 2005 December we have the data until now. It's like over 10 years, and over 50, like nearly 15 years data we have, and it has always been above 8%, which is very good. Let's see that if it pays any dividend. Yes, it does. In Google, when I type that, you can say dividend yield 2.25%. A company that pays dividend, it gives a very strong image that it's doing financially very good, because dividend means that after the company has paid the debt, or they have paid the debtors, they have paid their loans, their dues, and everything, they still have money left, and that money they give to shareholders. So that's extra money. So if a firm is able to give dividend yield, that means they're generating a lot, like they're doing very good financially. So dividend yield, even though it's not a big percentage, but still they have extra money. That's extra money. So they're doing financially good, maybe. Let's see if it has any patents. I just want to see if they have any patents. And I've just left the link in description of this video. You can just click that, just yeah, patents. And I'll just search that. And what I'm more interested in is, one second, I'll just see if this is exactly what I'm looking for. I'll just copy this exactly and then paste it, because sometimes firms have similar names, so I don't want to get it wrong. So it's Viacom International. I think that's the one we're talking about. Yes, Viacom International Inc. And it has patent in 89, in 2011. It has patents in 2016, 2013, 2017, and so on. You can just see. So it has a lot of patents, recent patents as well, which is very good, because it's important that the firm has recent patents as well, because it might be innovating when it started, but then it should have recent patents. But the thing I want to point out is that I'm not looking at inventors, because I'm just looking at applicant and assignee, because these are people, or these are people who have the full rights of the patent. So you need to be careful about that. And you can just go through the list. It's a big list, so it has quite a lot of patents, which is very good, because patents give a moat and competitive edge, and it means that the company will be doing good in future, hopefully. And lastly, I want to see if it has any reviews in Indeed. uh, what the employees think of it who are working here. There are 561 reviews, and it gets 4.1 star, which means that it's doing very good. The employees think that it's brilliant firm, because there are so many reviews, 561, and it gives 4.1 star. You can just read through it as well. Right now, I'll just go to Glassdoor, which is very good website for this thing as well. And I think Glassdoor has more reviews. Yes, it has 1.9 thousand 900, like 1.9K reviews, and it says 3.5 stars. That's fine. That's also good because the reviews are nearly 2000. So for that, 3.5 star is really good. You can just read through it as well. And if lastly, I just go to Yahoo Finance, I just want to show you what the key executives, who the key executives are, and what they are earning. I'll just go to profile and I'll show you the sectors: consumer cyclical, industry is media diversified, full-time employees are 10,400. And if you see, there are five executives and their title and their salary. So each of them have their salary shown, the firm has shown. So it means that, the more information the firm shows, the more transparent it is, the more better, the more trustable, it appears to be. So they have all the salaries shown, which is very good. It gives a good image of the firm. And what else is left now? Yes, if I want to know that how big is the firm in terms of market cap, I'll just type it in Google and I can just see stock. Just one sec. Yes, so it shows in market cap is in billions, 12 billion, which is, a big firm. Like a billion firm is a big size firm, so it's a big size firm, not a medium size, hopefully. And